supply and demand is also relatable in financial markets.
Absolutely.
Now, I got to ask you a question. The last time you were on a beach and you walked through that sand, what did you leave behind you?
That would be footprints.
Besides a trail of wrappers of
Yeah,
all the
right.
candy you were eating, but footprints, right?
Correct.
Now, think about that when you think about institutional trading, the big money. When the big money is buying and selling in the financial markets, they leave a footprint behind them. They are kind of showing their hand, so to speak, like what you talk about on a price chart.
Hmm.
And that's where proper investing decisions are made is on a price chart because that does not lie. Let's talk about supply and demand and how that really works in the financial markets.
Yeah. Before I get into that, I just want to say this that, I started talking about confidence. And the primary enemy of confidence is fear. It's fear of the unknown. It's fear of potential loss of capital. It's psychological. It's the wrong mindset. And our goal is to kind of change that mindset. Most people that are out there investing on their own, let's be honest, have the mindset of a novice or a loser.
A loser, that's
Well,
kind of
I'm
tough.
sorry to say that, but that typically that is what happens to the retail trader over time. They struggle to make profits. That's not the case with the institutions. Though the institutions, the big players, the smart money, the major Wall Street firms, the big banks like Goldman Sachs, hedge fund managers. We always mention Warren Buffett, but
Uncle
those
Warren.
those guys are they're very smart. But the key is they have enough money to impact where price is. And when you think about it, if you're going to be in any of the markets, not just the stock market, but the futures market, the foreign exchange market, the options market, the goal is to have price go in your favor, whether you are investing for an upward move in something or a downward move in it. What do you want to do? You want to find out when that price first turns, when it changes direction, and then you want to have a good idea of how far it's going to go because that's your profit. Well, how do you do that? I mean, how can you tell when price is going to change? Well, first of all, understand why price changes. And that's the number one thing that is part of our education is the knowledge of how the markets work. And it really is true of any financial transaction. When there are more buyers for anything, it's going to drive the price up. When there are more sellers for anything, it's going to drive the price down. That's supply and demand in the financial markets, but it has to be in such enough quantity that it really has an impact on price. You, Josh, and I can't do that. Even if we sold everything, in fact, we've got a class going on right now. If we had everybody in that class sell everything they own, buy shares of one stock, we probably couldn't see a move on a price chart. So it's key. Number one, learn how to read a price chart because everything you need to know is there on a candlestick price chart. We teach our students how to analyze a price chart, much like a radiologist would analyze an X-ray or an MRI. But the institutions are driving price. That's the bottom line. And the best trade you can make, the best position to get into something or out of something is when the price turns at or close to the turn in price. That always happens when that buy-sell relationship, the supply and demand relationship, is out of balance, caused by a big player or big players.
Yeah, I'm glad you brought that example up because it takes that millions and billions of dollars to actually move the market. And you have to understand why that is. Why does price change? And it just comes down to supply and demand, where the big buyers are, but also where the big sellers are. And if you think of it this way, what does Costco do in their business plan? They buy at a wholesale
Sure.
price and they sell at a retail price. That's what the institutions are doing. They're buying low, selling high. That's what the in retail, or I guess us as the public, want to understand and learn techniques and strategies on how to buy a wholesale, but also sell at retail. And as I mentioned, our step-by-step rules-based strategy, Al, is for trading any asset
Hmm.
in any market. Now, when we talk about assets, we talk about stocks, we talk about options, we talk about futures and forex. Why is the smart money not only investing in stock? Why are they also investing in the great markets, like especially forex, phenomenal market, and the futures market? Explain why they are and then what they are.
Well, it's because of the opportunities. If you think about what is the reason that those companies are in business, why did Goldman Sachs form? Why does Warren Buffett invest? They invest for a profit. They want to make a profit, and they want to do that by using all of their dollars in the most maximum potential benefit to them as possible. And that doesn't always come with the stock market. It certainly doesn't come with mutual funds. All those companies that we're talking about, the big hedge fund managers, the professional traders, they're not trading what the Wall Street firms are putting their clients into, which typically are mutual funds. Why do they do that? Why do they put their clients into something that they're not in? And it primarily is because the business model that they put together is put together to their benefit. And when you think about it, the people that are in power, they make the rules, they set the rules, and the people that set the rules put the odds in their favor. That's why casinos always win, because they set the rules and the rules are in their favor. The same thing is true in the market. So instead of fighting these guys, and you can't beat them, so you might as well just join them.
Isn't that old saying? If you can't beat them, join them.
Can't beat them, join them. That's exactly what I said. And that is true. So why fight that? Why try to fight the people that actually are moving the markets, that are impacting the price of virtually anything that's out there? Just follow them. And fortunately for us, you mentioned the footsteps in the sand. Well, fortunately, they leave footprints, so to speak, on a price chart that we can follow. So they're trading something that's different. For the reason I mentioned is because they have greater profit potential with those, and they can realize a profit in a shorter period of time. What are they doing with most of their clients? They're telling you that in order for you to be successful, you have to look at this as a long-term experience, a long-term venture. In other words, put something together and hold on to it for decades, maybe 30 years or 20 years or 40 years.
Is that term buy and hope?
Well, yeah, we call it buy and hope. I think most people recognize it as buy and hold.
Mm-hmm.
I actually will go a step further and say it's buy and pray.
Mm-hmm.
Well, it's a great business model for them because they can give you some ideas on a portfolio to put together and then tell you just to hold on to it for decades. And don't worry about the crashes. Don't worry about the corrections, because the market will always come back. And it does. It always does come back. But every time your portfolio goes down, it has to fight to come back again. You know, it would be a lot like a race. If you and I were having a race, the finish.
All right, let's talk about that one.
The finish line is financial security. Okay, I'm willing to admit that, you're probably in better shape than I am. You have longer legs. It would seem logical that you're going to beat me. So the race starts. You take off at a sprint, and I'm taking off at a jog.
Mm-hmm.
Actually, that's my sprinting, but it looks like a jog. So you're way ahead of me, and you can see the finish line. You know you've got this made. And all of a sudden, you fall in a hole,
mm-hmm.
and I go jogging right by you.
Mm-hmm.
That hole might even have been dug by me and covered
Probably.
up. But so by the time you get out of that hole,
would be like a fee.
Or a down market.
Mm-hmm.
So by the time you get out of that hole and possibly catch up to me, it's taken you a while. Now you maybe you go by me and you can see the finish line there, and all of a sudden you fall in another hole.
Mm-hmm.
And I go jogging by you right through the finish line. I win, you lose. What if you had like a little GPS thing that showed you where the holes were, and you could just go around the holes? You would have beat me significantly. That's kind of what you can do in the market and what happens in the markets. Every time that your portfolio goes through a correction or a bear market, it has to do much better to get back than, in other words, the returns have to be bigger than the loss. For example, if you have a 50% loss in your portfolio, it has to return 100% to get back to where you were before you have a potential for profit. So being protected is huge. The institutions do that. They know how to protect their assets, not only to protect their capital, but also to protect their profits. And it's the same thing we do. We show you how to enter a trade with a low-risk entry point, with protection if you're wrong, because you're going to be wrong at times, but then also protect your profit. And that's where most people really don't have a plan. Their advisors have been saying, just let's get into the market. It's time in the market that's important. They disregard price. They disregard the protection. They disregard taking a profit. And those are things that we feel are important. That's what we teach our students, so they can participate in maybe those shorter term investments that the institutions are doing.
You know, Al, with your extensive background and knowledge, I mean, I learn something every single day when you speak. And you know what I learned today?
Mm-mm.
Do not race you, because you will sabotage.
I'm digging holes.
But that's the key. I mean, think about this. You have the tortoise and you have the hare. Who always wins in that cartoon?
Mm-hmm.
That tortoise always wins because he is slow and steady. I mean, think about it. I was watching that Cars movie, and I can't remember the names. It was Lightning McQueen, and I might have been Mater or something. And Lightning McQueen was racing around, but what happened is he went off the track and went into some thorns.
Yep.
He ended up losing
Yep.
because he was going so fast, but he got caught somewhere. That's like
Right.
fees. That's like down markets in the financial markets,
Right.
in retirement accounts, trading retail accounts as well.
Yeah, it shows consistency is important, and not letting your emotions get involved in entering or exiting a position.
You're exactly right. And here's the question. Do you want to be the tortoise or do you want to be the hare? Al, I want to continue that discussion on that slow and steady wins the race, but with confidence within retirement accounts in the next segment. This is Josh and Al, Investing with Confidence. We will be right back.